Hi guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about how to spot recession-proof companies. Look, there's so many companies out there to dig into, obviously, maybe 11,000 or so last count. So it's pretty important you choose stocks to invest in wisely, okay? You're gonna have to pick just wisely, especially because these stocks have the potential to impact you and your whole family and generations for a long, long time into the future, you guys, as long as people know how to do this. So with all the uncertainties in the market, what I want for you guys is to get you ready for anything that could happen next, anything, which is why today I want to discuss how to spot recession-proof companies. Okay, so let's get started. First off, is a deep recession coming? That's a huge question. Certainly isn't impossible. We know that recessions come regularly, typically every 7 to 10 years. In fact, some investors right now firmly believe that we're in a market bubble and it's about to pop on us. Now, I don't know about the pop on us part, but I'm certainly one of the investors that thinks we're in a market bubble. I don't have a crystal ball, right? But we can still make really smart investing decisions just with the knowledge we have, whether this thing blows up on us or not. So you got to do some research, okay? That's the next thing before you invest in any company. You really have to understand you're going to do some reading here. And the way I want you to do that reading is to look at what we call the 4 M's. And if you've been watching any of these videos, you guys have heard about these before. So the first of the 4 M's is the idea of meaning, that the company has meaning to you, that it connects with you, that it aligns with your values, that these are kind of businesses that have a certain kind of integrity, some of them quite a lot, some of them maybe not so much. And what you want to avoid is being a hypocrite. You don't want to own businesses that you would be embarrassed to own. You'd be embarrassed to have your children think that you own it. And when you buy one share of stock as a Rule 1 investor, you already know this, it's like you own the whole company. So first off, connect your values with this business's meaning. The next thing is, besides understanding how this connects to you, is whether this business has a durable, protective quality to it, that it's some sort of a niche business that can really protect itself. We call this thing a moat, right? So something that protects competition from coming in and stealing away the control that they have of this part of the market that allows them to really be recession-proof. This is what makes a recession-proof company. This is what allowed companies to go through the Depression in the 1930s without failing, right? They may have cut down on their employees, they may not have done the revenue stream, but they were a successful company continuing to make cash flow, even in the worst of economic times. So this is what a moat is all about. Coca-Cola, for example, is a company that has a great big moat, right? A gigantic brand moat. And it's got this amazing thing called a switching moat that allows it to keep distribution space on these shelves in Safeway and Publix that bring people into those stores, and they're not gonna get rid of that shelf space because it's so important to the grocery store. So this is a very, very powerful brand and a very, very powerful switching moat. And I'll tell you what, there are some other companies out there that can just have the same level of security even in the most turbulent times. That's something for you to think about right now. Maybe you can send us an idea or two. Always looking for something really good. So look for something that's going to get better even with turbulence in the market. All right, the next M, the third M, is management, the all-important management. It's just like a fighter jet without a pilot, right? Or a horse without a jockey. Like, every company's only going to be as good as the people who are leading it, at least during that time period. And although, we basically like to say we want to invest with people that have integrity and talent, we don't ever know for sure until the fit hits the shan, right? And then you discover maybe they don't have the integrity you thought they did. So what we really want is to go back to number 2M, which is moat, which allows a company to be so strong that an idiot could run it, because sometimes an idiot will. And so if it's got a great moat, it can even overcome management that has lack of integrity or a bad talent. So ideally, we pick people that are great. That's the ideal thing. And by the way, people who match our values, people who are not overpaying themselves, people who are not just mercenaries, people who are not going to turn traitor. We want really good people to manage our company. My favorite kind of manager, to make this really simple, is people who founded the company. They're usually pretty much on the owner's side because they're a huge owner in the business. All right, now most importantly, this is the key to actually being able to do good investing that in the long run will produce great returns, and that is you want a great margin of safety. So when you buy a business, there's just no guarantee that this thing is going to increase in value over time. A lot happens out there. It's a fast-moving world. Things can change. So we got to buy the business with a gap between what it's worth today and what you pay for it. And this gap is called a margin of safety. Effectively, it's kind of like buying a $10 bill for $5. Just think about it like that. A margin of safety is about 50% off what the business is worth. Boeing, for example, is a company that got into big trouble with the 737, still having trouble with the 737, but it's such a powerful brand, number one. It's a toll bridge company, number two, which means if you want to have a company in the United States that makes commercial airliners, Boeing is it. There aren't any others. In fact, there's only two in the whole world, Boeing and Airbus. So it's an almost total monopoly company, which means it's probably going to survive any level of stupid management decisions that it could have. And it clearly had some pretty stupid management decisions. So it's going to get through it. Now, when Boeing goes into an event, it matches the values that I have. I would like to own the company. It drops into a price range that puts it on sale. In fact, at one point it got so cheap that just the defense portion of Boeing was worth what we were paying for it. We got the airliner side for free. So that's what you're looking at when you're looking at a margin of safety kind of a deal. You want something that has gone on sale to give you this big margin of safety. So we want you to go through these 4 M's, for example. For example, on, let's say, Chipotle Mexican Grill, you look at it and you say, does this company match my desire for companies to be in the world that I really like? Sure, it does. I really like their product. It's all natural food, organic food. It's great. So that's the meaning of the business. Plus, it's got its own niche in terms of really organic, natural food in the fast food industry. The only one out there that does what they do, which is fantastic. And then their moat is exactly that. Plus, they have secrets that allow them to produce all this natural food every single day with 2,000 restaurants across the whole nation and do it safely. Yeah, I know you're thinking they had E. coli, but that only was a brief thing that allowed me to buy their company super cheap. So that's the third M. And then management team, fantastic. Okay. And then we can buy the thing on sale because they had this problem with E. coli, got the company super cheap. In fact, we picked it up at around $280 a share. I wish I'd held on to it until it got to where it is right now, which is about $1,500 a share, but I sold after I made double my money. Okay, well, that's a mistake we can talk about later. That's the kind of mistake we like to make, frankly. If we're going to make a mistake, make it just by doubling your money instead of quadrupling it. So you go through the 4 M's on every company that you want to own. If it passes the 4 M's, if it passes all 4 of them, you go buy it. If it gets 3 of those 4 M's, meaning moat, management, then it goes on our watch list and we want to own it. We're just going to wait for this opportunity to come along when there's an event relating to that company. Typically a recession will do it and put it on sale. By the way, there's a great guide for you guys here because I know this is a lot to take in all at once. So we created what's called the 4M guide. And we're going to be sure to leave you with that resource here so you can find in the kind of inflation-proof, recession-proof, superstar companies that are going to do fine even if the market does really crash. So download this 4M guide. It's really good, and it's a really easy-to-use PDF. It just covers everything you need to know to analyze and spot those wonderful recession-proof companies. And now I'd like to hear from you guys. Did you spot any, right? Have you found any companies that look recession-proof? Send them in, sports fans. We're always looking. And leave a comment below with your answer, and I'll be sure to follow up with you guys. And thanks for watching. Now go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about spotting recession-proof companies, guys, just hit the like button. And please share the video with your friends. And if you want more investing content, subscribe to my channel. Don't forget to click the button on the screen for the free gift. Awesome. Thanks again for watching. Time to go play. See ya.